Filing the wrong income tax return can delay your refund, trigger a tax notice, and even cost you valuable tax benefits. And with ITR-2 now available for assessment year 2026-27, tax experts say many investors could still be making that mistake. So who needs to file ITR-2, and what are the biggest mistakes taxpayers should avoid? Many taxpayers assume that if they earn a salary, ITR-1 is enough. Not always. Take this example. A salaried employee earns long-term capital gains of 2.8 lakh rupees from mutual funds. Because those gains exceed the 1.25 lakh rupees exemption limit under Section 112A, that taxpayer must file ITR-2. The salary income does not change that requirement. And if the wrong form is filed, the return may not be processed. The tax department can issue a notice, and if the error is not corrected within the prescribed period, the return could be treated as invalid, potentially attracting penalties and interest. ITR-2 is meant for individuals and Hindu undivided families or HUFs who do not have business or professional income but have more complex sources of earnings. You may need ITR-2 if you have capital gains from stocks or mutual funds, have long-term capital gains above 1.25 lakh rupees under Section 112A, own more than 2 house properties, hold foreign assets, earn overseas income, are a non-resident, are a company director, or hold unlisted equity shares. The wrong return can create another problem. Capital losses from shares, mutual funds, or property can only be carried forward if the correct return is filed within the deadline. For example, a taxpayer with a short-term capital loss of 1.5 lakh rupees can carry that loss forward for up to 8 years, but only if the return is filed correctly and on time. Tax experts also expect closer scrutiny of foreign asset disclosures this year. The Income Tax Department is matching information across broker statements, capital gains schedules, and the Annual Information Statement or AIS. Any mismatch could attract a notice. Resident taxpayers must disclose overseas bank accounts, foreign investments, ESOPs, and RSUs under Schedule FA. Employees receiving stock compensation from foreign employers need to be especially careful. The same income may require disclosures across salary, capital gains, and foreign asset schedules. Missing even one disclosure could invite scrutiny. Now, experts advise taxpayers not to wait until the last minute. Filing early gives you the time to reconcile AIS data, collect missing documents, and fix discrepancies before the deadline rushes. It can also speed up refunds, particularly for salaried employees with excess TDS deductions and investors who paid TDS on dividends or fixed deposit interest. The deadline for filing ITR-1 and ITR-2 is 31st July. For taxpayers filing ITR-4 without audit requirements, the deadline is 31st August. For many taxpayers, the biggest risk this year is not underpaying tax. It is filing the wrong return altogether. Follow Business Standard for more stories.